Good afternoon, and thank you for joining us for our Q2 2026 Economic Market Overview. My name is Corey Hoffer. I'm one of the lead advisors here at Hermitage Wealth Management. As many of you know, our firm has the privilege of working with many talented institutional investment managers. And today I'm pleased to introduce one of those to you, and Andrew Hartman from JP Morgan Asset Management. Andrew is a vice president, and for more than a decade, he's worked to help bring JP Morgan's research, economic outlook, and investment insights to clients. He's a CFA charter holder and a member of the CFA Society of Virginia. And we're always grateful to have access to the depth of research and institutional perspective that he and the JP Morgan team provide. Today, he'll be sharing his thoughts on the markets, the economy, and what investors should be thinking about in the months ahead. If you have questions about the content in today's presentation, please be sure to contact us. Our team will be happy to hear from you. Otherwise, Andrew, take it away.
Your summer, it seems like the 4th of July is literally right around the corner. So I hope you're having a great start there. Richmond, Virginia, where I call home, is starting to heat up this time of year. And I would say since your last quarterly update, so have the markets, right? At the end of the first quarter, markets were down for the year. And when looking at things like domestic US equities, and now we find ourselves up almost double digits for 2026 and very close to all-time highs. In fact, we've made a few here in the second quarter of the year. So a lot has changed just over a short period of time. We've seen things like naval blockades in the Strait of Hormuz, oil soaring to high prices, and now that we have the peace deal in the works, we've seen oil come back down on the other side of it. So it's been a tug of war, but I would say investors are feeling much better when you glance at portfolio returns this time versus maybe 3 months ago. So we want to walk through our thoughts around the markets, the economy, and some things that we're seeing across both domestic, international equities, as well as some commentary around the new Federal Reserve Chair, Kevin Warsh, in the first meeting that he just conducted. So Mitchell, I'll ask you to bring the slides up on the screen here, and we'll kick it off. Okay, I've got it now. Very good. I see it now. My apologies. All right, diving into the first slide, let's talk a little bit about economic growth. So you can kind of see here, let's see if I get my screen oriented so I can actually see it well. You'll see GDP growth for going back to really 2023. And you can see here that economic growth in the first quarter was actually quite positive. It first came out over 2%. We've revised it down a little bit lower since then. But momentum is strong to start the year. If we take a look at the next slide, but one of the concerns from an economic risk perspective clearly was the conflict in Iran. Higher energy prices were upping potential for recession. And we're very positive to say that those risks have come down in a meaningful way. So our outlook here at JP Morgan from a growth perspective is that we'll see a continuation. In fact, when you look at things like the Federal Reserve of Atlanta posts an update on GDP, they expect strong economic growth in 2Q, and they expect around a 3% growth rate, almost double of what we saw that in the first quarter. You now take a look at the oil slide. You can see here on the screen, on the left-hand side, you'll notice the orange line is actually the price of the price of gasoline at a national average, and that peaked out around 4.5%. You look at it this week, you're down into the 390s, so we've come 60 cents off the peak. So less pressure on the consumer. Certainly, there'll be some downstream effects for the oil supply shock that we've had. It was the largest supply shock we've seen in the history of oil markets. So it's not that there isn't going to be any continuing effects, but the price in terms of markets are starting to respond with de-escalation through the Strait of Hormuz is the viewpoint here. So really positive in terms of the economic backdrop, in terms of what were some of the major risks we've had, that coming off the boiling point. We take a look at the next slide. I want to transition into inflation. Clearly, inflation was pressing higher in the second quarter, with the green component on the far right-hand side of this chart is really kind of the energy prices were the push higher when we look at things like CPI. In fact, it was concerning when you had inflation over 4% again in the May print. Our view here at JP Morgan is now that oil is coming back. When we look into June, July, and beyond and inflationary measures, you're actually going to see that starting to come down. So we think the high water mark was the May print for inflation. Now, if you look at the other components of inflation here, it's not that inflation's gone. In fact, the headlines were just yesterday that the price of something like beef at the grocery store has gone up now 80% since 2019. So we're certainly living in a higher priced world. There's no doubt about that. We're not thinking that prices for the majority of goods and items that we consume are falling, but the rate at which they're rising, we think will continue to normalize between now. And we think inflation couldn't get as low as 2% by spring of next year. So it's going to take some time, but we do think that we've hit some higher levels there. Corey, any comments or questions around that?
No, I know that's, Fed target, still 2% and kind of holding firm on that. So it'll be interesting to see how that plays out over the fall months into the spring of next year.
That's right. So as you can see back on that slide, it's actually our view, not it's going to be driven by energy alone, but look at the navy blue lines. That's shelter. That's actually been trending slightly lower over the last couple of years here. We think that's a big component that continues. When you think about tariffs, we talked about them, nonstop last year. We actually think the tariff rate on U.S. imports in the fourth quarter of this year is 7, where the fourth quarter of last year was 11. And so, there's some things between shelter, tariffs, energy, we think that can help get back to a normal rate, but it's going to take some time, and we're going to have to keep an eye on that. One of the important items for inflation, next slide, is labor markets. So what is wage growth doing? And here you'll see on the left-hand side, just number of jobs added per month. We've actually had a pretty meaningful spike upwards in jobs added to the economy here recently. So that's another positive sign where we had seen some slipping. The labor markets we would define as tight, but not necessarily extremely strong. But on the right-hand side is the key for inflation. It's that blue line, wage growth. You're also actually seeing that has been decelerating, over the last few years here. If you're going to have sticky inflation that's not going to go away, one of the biggest fears that we would have is wage growth is actually on the uptick. And so as of right now, that's not a problem within the US economy. And so that's something that actually gives us, the thought that we'll continue to have a stair step lower. And this has been a short-term, mostly energy shock higher on inflation. So, we'll have to see how that plays out, but those are the views. Let's take a look at the next slide and start to transition into how people are feeling. People actually haven't been feeling that positive when looking across the broader US consumer base. In fact, the University of Michigan has done this consumer confidence survey going back to 1971. And the print that we just saw here in the month of May was the second lowest reading since 71. So a lot of Americans are actually feeling pretty doom and gloom. And I think there's a lot of reasons for that, right? Whether it be, inflation on the rebound, conflict and war that now is coming down. Clearly, political divide is still hot and heavy across the United States. And then you've seen, a lot of different things for what we call the K-shaped economy, the haves and have-nots. But if you don't have a home, shelter inflation's been real, right? If you didn't have cash in the bank, higher interest rates were not a positive. If you went to the grocery store or the gas pump, those were challenges. But when we looked at the broader economic backdrop I just walked through, we actually think that this is glass half full, not half empty. And I think it's a better economic backdrop than this sentiment shows. We'll talk about the markets. I think the markets at the levels they've been is probably a glass full. They actually see this as, the best of times. And so, I actually think probably the truth between the economy and markets and sentiment is kind of in between all of those. And we think it's a solid backdrop. although maybe not all the excitement that we've seen in a short period of time on markets. But I would say, is it a good reason not to invest because consumer sentiment is low? And the answer is no. Just look in the upper right-hand corner of this chart. When consumers feel bad, it's actually a contrarian signal for equity investors to lean in. And so we show you, if you take the average of all those blue dots when sentiment was at a bottom, which we're at right now, could go lower, but at this juncture, it's certainly a low that we've seen for a few years. And you look at the forward 12-month US equity return, right? Buying at those bottoms, on average, you see about a 24% return on equities 1 year later. But if you wait until sentiment's really positive, right? Wait till the war is over, wait till inflation's gone, wait until politics are just the way you like it, right? And 12 months later, forward returns are actually less than half of what is normal, less than 5%. So I'd say Americans feel bad, but as investors, that doesn't make me feel bad. Let's take a look a little bit more into markets. And so if you start to think about, all right, how do you circle this square of a lot of consumers are negative, but we are really close to all-time highs? I would say there's two answers to that. Let's start with the first. Number one, I talked about it a little bit, the K-shaped economy, and then number two, earnings. So this slide will help us picture the K-shaped economy. What do I mean by that? The letter K, right? Part of the end of the K is up, part of the K is down. Again, it's to that haves and have-nots of the economy that kind of reference. If you look at the upper right-hand corner of this slide, you'll notice on those two gray and blue bars on the far right that the top 20% of households by income, it shows that 51% of all income is being captured by that 20% cohort, and 38% of all consumption is also occurring by that cohort. So what I'm saying here is the cruel reality for the US economy is that not every American's vote is equal. The higher income households are driving much more of the economic activity through consumption, almost 40% of it. And so, although that we certainly are living in more expensive times, what we see is individuals complaining about costs, but then taking that next European summer vacation, right? And so that's also true, right? TSA says we've done more air travel year to date than we did this time last year. Companies like OpenTable that does reservations at restaurants says we've done 10% more bookings this year at restaurants in the US than we did last time at this time. So, both can be true. The headlines you see on the news can be really dire for many Americans trying to make ends meet. But the reality is that the high-end consumer is consuming at a pretty high level, and that's keeping the locomotive of this economy still moving. Now, just a point on the bottom side of the K. So if you look at the bottom here, this talks about the average tax refund checks that went out in the second quarter. And so you actually have seen an uptick, that's the last column there, this year relative to last year. And that's because the benefits of the One Big Beautiful Bill actually led to slightly higher tax refund checks for the average American. So that's helping with consumption here in the second quarter. We think that actually follows through in the third quarter. And then when we look on the left-hand side, this talks about household net worth growth going back to 2019. The blue is the top 20% of households by income. The gray is the bottom 80%. But if you combine the two, household net worth has grown by $66 trillion over the last 7 years. That's incredible, right? Your house is worth more. If you're a business owner, many of your businesses are doing well. And if you own financial assets like the clients of Hermitage Wealth Management, right, are able to own things like stocks, bonds, alternatives, and others, right? You've actually done really well for the most part in your diversified portfolios. And so the point I want to make is that we have to be very careful with, the geopolitics of the moment, with, the midterms coming up in November and all these things that drive uncertainty and create emotion, that we continue to be long-term investors and we are not over-indexed to cash, but rather maintain an equity mindset. And that's really worked well for investors over the last 7 years. Tremendous net worth growth. We just want to make sure that we maintain that mindset and don't over-index to things like cash. But let's look at the other side of that as well, though, on the next page. And so I think the other answer to why are the equity markets doing well when sentiment's low is because earnings have been phenomenal. The bottom line for US corporations is the bottom line. And so if you look here on the left-hand side, you see a lot of bars. Look at the third from the right. It has a little bit of green and gray. That's the analyst estimates for earnings growth in the S&P 500 this year. And that's just Wall Street consensus. It's no special call by JP Morgan. And Wall Street consensus says over 20+% is the growth of earnings in S&P 500 companies this year, right? That's incredible. The average since 2007 is around, 7%. So I'm saying the growth in US businesses is 3 times the growth rate we generally see is what's expected for this year. Now, if you look at the far right gray line, that shows you US profit margins. And so profit margins are at a multi-decade high. For every dollar of revenue I receive in a business, the earnings I'm able to generate off that virtually never been better. And so, a lot of this has been around some of these tech-oriented businesses that have increased profitability, that are seeing a surge right within the spend of the build out of AI. But more broadly, a lot of these sectors are actually very strong as well. Let's take a look at the next slide. I want to spend a little bit about this boom in AI, and it really is a boom. You'll see here on the left-hand side just the capital expenditures in the 5 hyperscaler companies, right? So that's Meta, Microsoft, Google, Amazon. These are ultimately the individuals building data centers. And so the expectations from these 5 companies in 2026 is that they're going to spend over $700 billion in building out compute. That's incredible. $700 billion. It's hard for our minds to wrap around that number. But think about the Apollo project, 10 men to the moon. That was a 10-year investment cycle. If we bring that into 2026 dollar terms, inflation adjusted, that'd be a $250 billion investment. So what I'm saying is we're going to do 3 Apollo projects this year with just these 5 companies and building out compute for the future of many different things that we're going to be able to leverage off that platform. What's the view next year? Well, some of our research analysts are a little bit higher on the view that the CapEx can continue than even what this chart shows. And we think that you could see even $1 trillion in continual spend in the build out here. So that has a meaningful impact in terms of the raw economy. That also has a meaningful impact for the companies that are taking those dollars that these companies are spending and building out particular services and goods for them. So this really is the summer of capital. You're also seeing it in the summer of capital in terms of IPOs. We've had SpaceX go IPO. We're expecting, in the months to follow, IPOs from big tech companies like Anthropic and OpenAI. And so we're starting to tap not just cash flows, that's the right-hand side of this chart, not just the cash flows these companies are generating, but then you look at the green bar, the CapEx, and then you subtract the revenue from the CapEx, you get your free cash flow. That gray bar is now at the bottom. So these companies are starting to tap debt markets, IPO markets. And so this is kind of the next leg of the AI, is not just working off cash flow alone, but now having to go to other, parts of the balance sheet to be able to build out that. So let's continue on the next slide here. And so, when we look at the earnings growth rate by the sectors, clearly this has been dominated left-hand side by tech. Just look at the year-over-year earnings growth rates. But growth has been good in other sectors as well. And look at some of those gray bars. Those are actually more of what we call value sectors: financials, industrials, energy. And so I think there's a lot to like in those areas. We're going to talk a little bit about the concentration of markets, and they certainly have become much more concentrated over the last several years with this build out of AI. And the market capitalization has really been taken by, a few stocks, broadening out now into some of the other players outside of just the big ones. And so I think that's a good place to transition to the next slide. So we see here on the far right-hand side, these companies we call the Magnificent Seven. These are a lot of those big tech companies. You can see the names listed there on those first set of bars, right? This is NVIDIA, this is Amazon, this is Meta, this is Google, right? This is, Tesla, all the way down the list. And so they could do no wrong if you go back 2023, 2024, you started to see, as you can see here on the right-hand side, some divergence of performance in 25. And actually, year to date, you've got, three of these companies that are actually still negative for the year. And you can see that, only a few of them are actually outperforming the broad market. So we're starting to see what we call a broadening out. Outside of just these 7 stocks alone, we are seeing other companies really step into a leadership position and start to drive. So I think the point here is markets change incredibly fast as we're getting, an evolving world around us being disrupted by technology. Be careful with concentration. What worked yesterday might not work tomorrow. And so maintaining balance and diversification within your US equity portfolios, we think is really sound advice. Let's continue on the next page. And so, this is just a really good graphic to explain what I just said. We look at the top 10 stocks going by decades. Look at the first set of columns in green, 1985. IBM was the largest company in the S&P. You then look at 95 in the next column, 05 in the column after that, 2015 and 2025. And the last column is where we find ourselves today, currently, and some of the new entrants you now see in the top 10 there in orange. And so I would just point out to say that 2 things. Number one, the bars today are twice the size as the bars of the last 4 decades, meaning we're making twice the bet size in the passive indices in the top 10 names. And then the colors represent how, as technology has evolved over the decades, market leadership's been disrupted. Like, how many stocks that were in leadership in 1985 or even 95 are still in leadership today? And the answer is none. And so again, we think now is a good time to continue to be an active investor, to be understanding, why you're investing, what you're investing in, and not necessarily be caught up in a bit of this, strong movement to just a few stocks that, although look like leaders today, right? This technology thing is moving so fast, just like past decades, they might not be the same kind of leadership that they have a year, 2 years from now. In fact, if we did this in 2020, NVIDIA was not even a top 10 name in 2020. And today it's the number 1 name in the market. So it just speaks to how quickly this can change. Again, we think now is the time not to lose discipline. Not necessarily not be an equity investor. No, we still believe in that. But just understand what you own is the point. And certainly you have a team here that works every day to help you do exactly that. All right, let's take a look at the next slide. So we're just virtually off the tips of all-time highs. Let's look at the next slide. We think now is a great time to actually look at more diversification components. So let's take a step forward and realize that volatility is normal. So if you, Mitchell, advance to the next slide, I want to talk a little bit about looking at the equity market. Yes, as the last slide showed, equities have been on the rise for many years. And we think that'll be true over the years to come as well. But it doesn't mean that there's never a step back. And so on this slide, the gray bars represent the calendar return of US equities, but the red dots measure the intra-year decline that each year always has, the pullback that we see in any given year. So let me just take you to the second column on the right. Last year, equity markets ended up 16% from a price return, 18% from a total return when you add in the dividends. But the red dot was 19%. Think about that. So on the peak of the market in the first quarter of 2025, right, markets were up, but on February 18th, they then started to decline all the way to April 8th. We were talking about tariffs. We were having things like DeepSeek Monday and Chinese AI companies and all these different headlines that hit. But eventually the markets bottomed on April 8th. And on April 9th, Trump tweeted out, 90-day pause on tariffs, and markets jumped 9.5% on a single day. But the point is, from February 18th to April 8th, markets drew down 19%. So we definitely saw some volatility. But the average decline, when looking at the last 46 years, has actually been 14%. So what we saw last year was pretty normal. And what we should expect each and every year is something somewhat similar, right? So, again, right now is a great time to re-engage, to make sure that, there's nothing that's changed your goals and objectives on your portfolio plan. But the point of this slide is to say, there will be steps backward, but continue to give it time, because the real point is 75% of these bars have end up positive by the end of the year. So get invested, stay invested is the mantra that we truly believe. And it's not about trying to time the market and avoid the next drawdown. It's about having the right risk tolerances to be able to invest through these times and get into additional benefits on a go-forward basis. But let's talk a little bit about diversification on the next slide. So how has diversification actually helped? Well, diversification helped a lot last year. You saw things like international equities in your bond portfolio really providing some good protection when parts of US equity markets draw down. I call the diversified portfolio on this chart the white box. It's a little bit of everything you see. Each of these tiles represent a different asset class, whether it be US equities, large, small, whether it be international, developed, emerging markets, whether it be fixed income or high yield, which are some of the lower investment grade parts, or even commodities. And so, our view here is, again, it's hard to ever determine what's going to be the hot box next year. I think a lot of our investors didn't think that emerging markets would be the number one tile as we're heading into 2026. But yet, countries like Korea and Taiwan, who are critical to the build out of the AI boom we just talked about, have been huge benefactors of that spend. You think of memory companies like SK Hynix or Samsung in Korea, or Taiwan Semiconductor, which is the leading provider of chips to the world, right? Those sit in the emerging markets. Oh, by the way, this thing, energy and oil, has gone up over parts of this year. Emerging markets are also highly commodity based. And so, you might not necessarily ever have, hey, I thought that was going to happen. Maybe you're more predictive than I am. But the point here is to take a little bit of everything, to be diversified. And at times there'll be asset classes that don't help, but at other times there might be some that actually surprise you. So stay balanced. Let's go ahead and advance the slide. And so let's talk a little bit more about this international equities. You'll see in the middle of this page, the bars represent things like Europe or emerging markets, China, Japan, and the US. And the US actually was the lowest performing of those in 2025. Now, if you look at the far set of columns on the right-hand side, that's year to date. And we talked a little bit about emerging markets actually doing quite well. But look at why these markets are doing well. So the blue sections represent earnings growth. The light blue is dividends, right? And the gray is multiple expansion, meaning people are willing to pay more in terms of sentiment multiples. And the purple is the currency benefit or detractor. And so last year, when you look at that first column in the middle with a lot of purple, European stocks were up over 40%, but over 15% of that 40 was currency as the euro strengthened relative to the dollar. And then in the gray, multiples were expanding. But, I would call these icing on the cake. What I really want is a lot of sponge. I want a lot of cake. And that's the blue, that's the earnings. So Europe didn't see a lot of earnings growth last year. But emerging markets did. So that's something that we just keep in mind for our allocations. We like to complement part of our US equities with some of the EM, and we're also investing in Europe, but we're not necessarily in a real overweight position because we still want to see more of the earnings come through. I'm not saying we shouldn't have dollars invested in Europe. I think it's prudent to too, but just from a relative tactical positioning perspective, that's what's kind of driving that. Last year's return in US equities were driven by 85% earnings growth. That's fundamental. It wasn't a lot of multiple expansion. So, those are some things that we're thinking about in international, an area we like, but a little bit more into how we're portfolio positioning. All right, let's go to the next slide and talk a little bit more about fixed income and interest rates and the Federal Reserve. Like another place investors go to help diversify some of their equity exposure. This is the federal funds rate over time. So this is the policy rate that the Fed comes up with, a short-term lending rate to help drive policy and ultimately affects things like, loan rates, such as, your 30-year mortgage or credit card rates. This is the very beginning of that. So what we started at the beginning of this year was the expectation for many investors had was the Fed was going to continue to cut rates. In fact, the markets were expecting 2 cuts this year. Well, now that we've had some inflationary impulses, We have a new uh, Federal Reserve Chair, Kevin Warsh. Are we going to continue to get cuts? Right? The president certainly wants interest rate cuts. But now the markets have actually moved to the expectation there might be a hike. And that was kind of more on that inflationary surge, the movement of deficits and other things that just said, all right, we're not quite ready to be able to cut further. JP Morgan, our view is that we don't really agree there'll be a cut this year. I think the peace deal with Iran, if that holds and energy prices continue that move lower, actually give us the ability to not have to raise interest rates. And so we think that a cut is also unlikely. So just a pause here for the rest of the year is probably what we expect, unless the data changes in a meaningful way. Now, how does that impact fixed income? Well, let's take a look at the next slide. And so when we start to look at the yield curve, we actually have seen a slightly higher move in long-term rates, and really not that big of a move in the short-term rates on the left-hand side. And so when we look at this, we don't expect long-term rates to jump higher or really to jump lower in a meaningful way, but slowly grind higher on things like, the debt and the federal deficits within the US government continue to rise as we continue to have deficit spending. So I don't think that there's something that's going to bring long-term rates down. We're not calling for a recessionary period ahead. So I think, the interest rates where they're at are actually pretty high for bond investors and provide a lot of income. I think maybe if you're trying to be, really tactical in positioning, we would say, call it 2 to 3 years is probably a pretty good part in the curve that'll provide protection if rates were to go higher, but be able to lock in longer term yields as well. So that's kind of the fixed income update. Let's go ahead and advance the slide. And the point on this slide is to say, a lot of you might be thinking, hey, this guy's saying fixed income actually is providing a decent level of yield, but it hadn't provided a decent level of return over the last 5 years. In fact, it wasn't that long ago in 2022 where you got burned by bonds in a way you probably haven't felt in your lifetime. Well, what's changed now? Well, because yields are higher, this just shows you, when you look at high quality fixed income, starting yield, which is the bottom part of the chart, represents how high yields are. And then the left-hand side of the chart represents the 5-year subsequent returns. What I'm trying to say is bonds are pretty boring. If you tell me the starting yield today, I have a pretty good degree of confidence of telling you what the next 5-year future returns are going to be in something like the aggregate, which is 5-year bonds. And so what we're implying here is that we would expect for bond investors today, your rate of return is going to be shy of 5%, which is a heck of a lot better than the 0.5% return you got in the last 5 years. So what I'm encouraging you here to do is not abandon the bonds, actually stick with it. Now that yields are higher, I think the next 5 years are actually going to be beneficial for you to be able to use that as a source of income and return. It might not be a perfect diversifier to your equities. If inflation goes up, rates could go up and bonds could go down at the same time your equities go down. That's possible. But the return provider from here should be lower volatility profiles with a very nice return on income subset. All right, let's go ahead and finish on the last slide. Let's talk a little bit about alternatives. Maybe you've thought about alternatives, maybe you haven't. Private alternatives are a growing marketplace that investors are starting to tap. There's many different types of private alternatives. I want to talk about the benefits, but before I do that, you certainly have to know some of the downside risks of alternatives. Number one, generally you're giving up liquidity. Number two, these are long time horizon type asset classes. And so it's not something that we think is appropriate in every situation for every single client. But I would like to think about maybe 3 benefits to alternatives could have on portfolio construction. And so take a look at what I call Planet 60/40, the green and blue planet on the far right-hand side. It's clearly correlated to itself if you look straight down, a 1-to-1 correlation, meaning when it's up, when it's down, it's down. What I like about, parts of alternatives is some of them fall on the left-hand side. Things like private real estate, right, is negatively correlated to the 60/40. So that could be a benefit. And then, things like the size of the bubble is how much income these asset classes produce. They can be good diversifiers to things like bonds. And then the last thing I would say is how high up on this chart you go, you could also see potentially return enhancers. So things like that little dot in private equity. could be a good return provider. So I'm not saying private alternatives are for everyone, but think about how they can aid. Again, that's alpha, add returns, I, income, and D, diversify your traditional portfolio diversification. So diversification, I think, is a great theme to maybe end it on today. I think now is the time. The sun is shining. The roof doesn't have, necessarily any major problems. But if you got any small holes, go ahead and fix them now. We want to continue to stay the course and be long-term investors. We think now is a good time to revisit that. So I'll pause there and pass it over to Corey. Appreciate you having me on this.
Well, we appreciate it even more, Andrew. Thanks so much for being here. There's a great review of kind of starting out with the markets. It sounds like JP Morgan is very constructive on the U.S. economy. We've got energy appears to be normalizing. We've got inflation protections or projections rather are down according to JP Morgan. Looks like labor holding steady. And I think the two strong pillars of the economy we're seeing are U.S. corporations as well as consumer spending remain strong. So I think that's a positive outlook. What's really interesting about this period of time, and one we've never talked about in my past 25 years plus as a financial advisor, is the historical investment into infrastructure that we're seeing from these tech companies. I mean, I think that slide that you shared with us was remarkable. We've never seen anything like this in the past, not even close to it. So it's worth understanding and giving consideration to within the investment portfolio. But I think the theme that you chose to go with today, Andrew, was more about being both disciplined as well as diversified. I think two really key themes, which I think if investors are able to kind of understand the shiny stuff, but at the same time realize that sticking to a strategy is probably most key right now. In times like this, they're going to fare the best. So
balance, absolutely.
Absolutely. So again, Andrew Hartman, JP Morgan, we very much appreciate your insights and knowledge today. We'll definitely have you back on in the future. And again, participants, if you've got any questions at all, please don't hesitate to reach out to us here at the office. We'd be happy to hear from you. Thank you all. Bye now.